Good day, everyone, and welcome to today's Real Estate Insight. I'll be taking you on the topic, making smart real estate investments. So we'll be taking this topic to know how well we can build wealth through property when it comes to real estate investments. And we start the introduction by looking at the importance of real estate as a long-term investment. So why smart investing matters. So we're going to look at some of the factors and the risks it involves and the tips to take home on this topic. So first, we'll be looking at types of real estate we have. The types of real estate we have and that most of us practice. The first one here is residential real estate. And when we talk about residential real estate, it's where we all live in. And the next one is commercial real estate. When we say commercial real estate, is a place like this, an office space, where you come to work and go home. So it's not really a place where you sleep over. And the next one says industrial real estate. So most places are specified as industrial because of heavy-duty factory that is being planted there. Places like Ilupeju here in Lagos, there are some zones there that are strictly industrial uses. The next types of real estate is the REITs, the real estate investment trust. This is more or less like a stock that most people who don't want to own physical real estate buy into to invest as a smart investor. And the next one, we have land. Generally, land is what all beginners of real estate investors start with to start investing in, because it's the least where you can have risks in it. So next, we're going to look at the benefits of real estate investing. The first one here, it says passive income. When we say passive income, it's an income that we get when we are investing in real estate, that you get as a rental income and a growing income in real estate terms. And the next one here is appreciation. When you invest in real estate, you tend to have an appreciation value. Your investment appreciates by the year, by the month, depending on what you invested in. And also we have tax benefits. When you invest in real estate, the tax benefit here is you pay less tax. Instead of keeping the money in the bank or investing in other things that are not real estate, you tend to have more benefit when it comes to tax. You pay less. The land use charge is a form of tax that is so minimal that you won't feel the tax being so imposed on you. So it also has tax benefit when it comes to real estate investing. And the next one is leverage. When you say leverage, it gives you that leverage that, oh, you have something to fall back in when you invest your money in real estate. That, okay, you can quickly liquidate when it's time to liquidate also. And the next one here is inflation hedge. We always hear about real estate being an inflation hedge. When every other thing is being affected by inflation, the real estate it's not, because it's already hedging against it. It has its own economy that when everything in the economy is getting worse, it takes time for it to go down, especially in this part of the world. And now we're going to look at the key factors for smart investments. So the first one we are looking at here is location. Before you can say you want to go into real estate as a smart investor, you first have to look at the location. Where are people going into? What are people saying about this location? How is the location going to benefit me? If you are not looking at the location as the very first factor, you are not ready to get into real estate investment. So the next one is the market trend. When we say market trend, is what are people saying about real estate? You just have to do all of your assignment that, oh, this area that I'm going to, what are people saying about it? What's the market saying about it? How's the flow going when it comes to that location as well? And we have property condition. Let's assume you want to buy an existing property, a landed property. As a smart investor in real estate, you have to look at the condition. How long has the property been built? You have to look at the age, the condition, what is the plumbing system there, what is this, what's happening there, is there any problem in that property? And let's assume you also inherit tenants in that building. How are the tenant copy? Is it a tenant that you're going to evict, or you're going to retain them, inherit them? That's the term we use when it comes to real estate. You inherit some tenants in a property, assuming you buy the property with the tenants in it. So you have to look at the property condition. And we have the cash flow. How's the cash flow like? Is it making good return or not? You have to be able to calculate this, that, oh, what's the cash flow of this property I'm going to invest in? And the last one here is saying exit strategy. When we say exit strategy, real estate should be able to give you that when you are coming into it, you're happy that, oh, I'm getting it. When you are going out of it, is it easy to liquidate? Like here at Adbon, we have the resale order. So it's easy for villa owners to come in and exit. So it won't be like a trap that you buy a property, you are not able to exit. So there must be various exit strategy. So next, we are going to look at the market research and analysis. So the first one here is looking at the local market trends. When you say local market trends, it's the market around you. What are they saying about the real estate within your vicinity? Oh, let's assume you want to buy into Ikorodu. What are the people around there saying about properties in that area? Is it easy to sell? Is it easy to buy? Are there issues there? You have to go and do your market research on all of these properties before you can invest in it. And the next research here to analyze is neighborhood analysis. When we say neighborhood analysis, what are the going concern in that neighborhood? Is it a secured area? Is it a red district area? Is it a serene area? You have to look at all of this when it comes to investing in real estate. And the next one is rental demand. Before you can put on any property in a location, you have to look at what is the going rental demand. What are people looking at? Are they looking at duplex in that vicinity? Are they looking at block of flats? Are they looking at face me and face you, what we know as bungalow, tenement building? So we have to be concerned with the rental demand. What are people in this area demanding? People buying property or renting property in this neighborhood, what are they demanding? So that you don't build 3-bedroom flat and everybody is asking for a room apartment. So you must be careful before you put up an investment in that neighborhood. And the next one here, we have comparable sales. Comparable sales is, let's assume you buy a property and you want to sell. You have to be able to know, okay, what is my neighbor selling? What is the going price? And mostly you can call a professional, a valuer, to value the property, to know the comparable sales before you can put it up to sale. If you don't do that, you won't be able to put up a property for sale. So that's the essence of doing the comparable sales as a market research and analysis. So the next one, you're looking at the financing options. Before you can go into real estate as an investment, you have to weigh your financing options. How do you raise money? How do you come back the money? Because if you don't put down your plans, you won't be able to finance the project. That's why you see most of the time you have abandoned buildings all over Lagos and other places. You see someone building up to some extent and they stop because they've not sat down to look at how they are going to finance the project up to the finish level. So the first one here, we have traditional mortgages. So when we say traditional mortgage, we know our mortgage banks. where you can go into a financial institution and say, oh, you want to do this building, you need this, and the next thing they ask you, what collateral do you have? So you must be able to tender a collateral for you to be able to what this traditional mortgage system of financing your project as a real estate investor. So the next one is private lenders. When you say private lenders, is you have friends or family or a lender, a private one that can loan you the money that, oh, have this, what's the duration of payback, you have the agreement, and you are able to get the project financed by the private lenders. And we have the hard money loans. When you say hard money loans, it means that, let's say, it's generally a real estate loan that you get to finance a real estate project. So that's why it's called hard money. It's not a long time loan also. It's also a short time loan that you get to finance your real estate project. And we have the seller financing. When you say seller financing, let's assume you are the owner that built a property and a buyer wants to get the property from you, but they don't have the full money. You can have an agreement, oh, you pay in this. It's a way of mortgaging as well. That, okay, you can pay in 6 months, you can pay in 3 months. So the seller becomes the financier because they've already built the houses. All you need to do is to pay bit by bit till you finish your payment and it becomes yours. So that's the financing, seller financing meaning. So the least one here is partnership. You can go into partnership with someone. What most real estate investors do is a joint venture, what we generally know as JV. So you go into a joint venture deal with someone who already has land and you have the option to build. So you go into partnership, probably you can't get land in that area anymore. You say, oh, let's come together, you have the land, let me build on it. And we share the building 50-50, or depending on the ratio, both of you agree to share the project, the property with. So here we have the calculating return on investment and cash flow. So when you already invest in this property, in this real estate property, how do you calculate your return on investment? First is the cap rate, that's the capitalization rate. When you say cap rate, it simply means, okay, you dropped this amount of fund to build this property. How do you make back the capital? That's what the cap rate simply means. Oh, let's assume you have 10 million naira and you want to build a bungalow. How long will it take you to recover your 10 million naira? How many years will it take you before you start making return on that investment? That's what we mean by the cap rate. You have to be able to calculate that so that you won't see the investment as a waste of time. And the next one, we have the cash on cash return. When you say cash on cash return is, oh, let's say you already have the cash at hand that you want to build. So how do you compare that? Oh, if you are dropping this guy, the return must also be coming in as you are investing. It's not like you are investing and you are waiting a longer period to get your return. That's what the cash on cash return means. So the gross rent multiplier, just like the name goes, rent multiplier. If you have this, you must have the building already, and the rent you are receiving, how do you multiply it? Do you use the rent to get other investment so that you keep getting more rent from that? That's when you see all these developers, after building a property, they said they want to collect 3 years rent. That gross rent, they use it to go and start up another project. So it's easy for them to multiply their rent. That's what the gross rent multiplier means. And we have the example calculation. So when we say example calculation, let's assume you have different portfolio of real estate. You start putting the calculation on it. Oh, what's coming from this location this year? What's coming from this location? You are bringing them together to know what your cash flow for that whole year is going to be. So you must be able to calculate your cash flow as a smart real estate investor. So let's look at the risk management when it comes to investing in real estate. First, we have the vacancy part. It's a risk because if you build a property and nobody is renting it, it becomes a waste because you are not getting money that you are invested. Your money is being tied down. That's why you must do your market research to know what is the going demand for property. You don't build a duplex where people are looking for a 2-bedroom flat. So when you don't do your market research, you tend to have a high rate of vacancy in such property. So we have repairs. In some property, the repairs are so high that it's difficult for the investor to make their money back because they spend repairs on maybe doing plumbing work, doing the fencing, maybe there is a breakout, there is a break, the fence break, doing a weather or something. So when you spend more on repairs, you won't make your return on investment as a real estate investor. So we have legal issues. When you say legal issues, there are many legal issues. It could range from, you bought a property, the property already belongs to someone else, and you are going to court. All those are risks already because you are not sure if the property you are going to win in court. So if you are not sure of such cases, it becomes a problem, and that stands as a risk. Also, you can have a multi-tenant building. Let's assume the tenants are not making payments, then it becomes a risk because you won't be able to calculate your rent at the end of the year and you won't be able to make money from such investments. And we have diversification. When you say diversification, let's assume you make some money from real estate and you're trying to diversify into other kind of investments. If you don't make money in those investments that you have taken real estate money to invest, it becomes a problem because you won't be able to multiply your portfolio when it comes to real estate. So you must be a smart investor to know, what am I diversifying into? Is it a low risk investment also, like real estate, that will give you more edge against every odds? So we have common mistakes to avoid when it comes to investing in real estate. So what are the common mistakes? Over leveraging. You don't put all your eggs in one basket, like we always say. Let's assume Lekki is the location everybody is buying. You don't say all your money you are going to put it in Lekki. You have to be able to put it in different locations. Let's assume there is flood in Lekki and nobody wants your property. You're going to lose. But let's say you put in mainland, you put in island, you put in different states, then you are able to leverage when it comes to, you lose money here, but you make more money here. So you must not over leverage in a location when it comes to investing in real estate. The next one is skipping due diligence. Most people, because they want to avoid paying professionals, they will say, I can do it myself, I can manage it myself, I can build this, I can call a bricklayer to do this. By the time you are doing all of that, you are skipping the due diligence. When it's all fall back, you face the consequences. You are going to waste and lose more fun when it comes to that. So you have to avoid such mistake. And the next one we have here, poor property management. If you have poor property management, you won't make money in your property as well. So it's always advisable to give to a professional to manage your property, so you won't be able to say, I don't know, this is the law, I don't know this. But to a professional, they will be up to date with the laws of the states. So here we have the tools and resources you can use as a smart real estate investor to always use to invest. So you have the real estate calculators, like I mentioned in the previous slide. And we have the Zillow, Redfin, Victor.com. You can also go there to know how to also use those tools to calculate your investment. And we have the local tax assessor, a website also where you can go to use the tools to calculate. Let's assume you have various portfolio of investors. And we have the investment communities. This is very common. You have some group of people that will say, let's come together, let's build this property, this hostel. They do crowdfunding they build such property and they share the return on investment. So that is very common in this part of the world. While others, they are mostly used by individuals. that have portfolio of investment when it comes to real estate. So we have the final tips for success. How do we become a successful, smart investor in real estate? First, we have start small. Start with as minimal as at Adon we have at least the 150 square meter for motherland that you can also purchase when it comes to starting small with your real estate investment. Build your network. Have people that have knowledge in this field so that you can get more knowledge and know where to invest next when you have the fund, so that you don't just invest because people are going this way, you want to go with them. You must be able to have the knowledge of where you are going, so you don't follow the crowd to just invest and lose money. And you have keep learning. Learning, it's never a one way. You have to keep learning, unlearning and relearning. You don't use the knowledge you have gotten 5 years ago to keep operating. You have to keep learning and be patient. Real estate, it's not a short time investment, it's a long time game. You have to be patient when it comes to investing in real estate. So we have our closing quote, which says 99% of all millennials become so through owning real estate. So I know most of us have been hearing these quotes over and over. So for you to become a smart real estate, you must be able to follow the tips that have been listed and start small, be patient and all of that. So in that, we come to the end of today's training. Thank you for joining us. If you have any questions, feel free to drop in the comment section and get back to you. Thank you.